in Chapter 4, we're going to look very closely at the income statement. And getting started with that, I'd like us to kind of look at the diagram that I have in front of you. We have two companies, Belford and Corinth, and I'm showing a diagram of their quarterly earnings. So a very visual sort of thing. So if you were looking at these companies, what would you project the fourth quarter earnings to be based on the diagrams? So if we look at the first company, we can see there's been steady growth. We would somewhat anticipate, that in the fourth quarter, that would continue, right? Over here at Corinth, we started out the same place, but then we had a higher second quarter and then not so good third quarter. So, who knows? That's the big question mark. Who knows whether that fourth quarter is going to go up or whether it's going to go down. Well, this may be real. This may be what really happened to each of these companies, but it's also possible that Belford indulged in a little bit of what we'll call income smoothing or earnings smoothing, meaning that they may have actually had the income over here that Corinth had for the second quarter and third quarter, but what they did is, they took some off, and they took some out of their second quarter and moved it over to the third quarter so that it would look like there'd been steady growth. So they, in essence, shrunk the second quarter and moved some of those earnings over to the third in order to have the appearance of steady growth. That's income smoothing. Again, that's where you're kind of moving revenues or expenses from one period to another in order to have the appearance of steady growth or to have a smooth earnings. And that totally violates the periodicity assumption, assuming that we have the same accounting periods, that revenue and expenses are to be recorded in the accounting period in which they occur. So it violates that principle. The other concept I want to talk about real briefly, and it's in your textbook, is this idea of cookie jar reserves or a big bad. Cookie jar reserves or a big bad is when maybe a company has a bad year and they will overindulge in that bad year. In other words, they'll make expenses and liabilities look worse than they even are. So they exaggerate the expenses because they know, profits are down anyhow, so let's just make it look really down. And by doing that, they can do that through estimates, because we use a lot of estimates in accounting. So like estimated bad debt expense or estimated depreciation expense, they'll overestimate in this year of the big bad, and so then in the future years, they have smaller depreciation expense, smaller bad debt expense, so the future years look better than they actually should. So that's a cookie jar reserve. The other thing I'd like to talk about is, I'm actually going to pull from the textbook. So if you will turn to your textbook, this is page 160 is what I have on the screen. I just want to briefly kind of highlight, it's already in the book and you can read it, but I do want to highlight and make sure that you're concentrating on certain things. One is the value of the income statement. And we would have seen this in chapter 1 and 2. The income statement helps us determine the amount, the timing, and the uncertainty of future cash flows. That's the whole purpose of the financial statements anyhow, being able to project those. And we talked about that in chapter 2. Your authors talk about the good, how useful the financial statement is. We can look at how the company's performed in the past. Past performance helps analysts predict future performance. And also it helps us assess risk. And it gets back into here, the amounts, timing, and uncertainty of those. Uncertainty is risk. Future cash flows. So number 3 is kind of getting into that all over again. And the one thing I might really want to point out here is this idea of non-recurring sources of income. So we're going to see on the income statement, we're going to break out things that tend to occur over and over again, typical operating activity, from activity that doesn't occur very often. It's non-recurring. And we'll see the value of that on the income statement. The other thing I like about the textbook is it talks about the downside, the limitations of the income statement. Sometimes companies omit things from the income statement. Typical one omitted actually is the value of employees. They often don't get recognized. This also lists some other things, increasing the value of a brand. We don't recognize that because it hasn't actually occurred, or we haven't realized it. So if it hasn't been realized in accounting, we don't recognize it. And then these unrealized gains and losses on some investments. Oftentimes we don't recognize a gain or loss until we've actually sold the investment. Okay, and then number 2, the income numbers are affected by the accounting methods employed. So, if we use a straight line depreciation method, that's going to give us a lot different income number than if we use an accelerated method. So, and I like your book using saying, well, that's like comparing apples with oranges, very different things. And the last one too, there's a lot of judgment involved, especially with estimates. Like for depreciation, we estimate the life, we estimate the salvage value of the asset. All of that's going to affect earnings as well. Okay. Let's see. I also want to talk about on page 163. On 163, this is kind of, didn't print out very well, did it? But these are the elements of the financial statements. This is supposed to say the word revenue. But I want, there's a lot of narrative here. But I do want to point out, you really need to know these elements by now. We've covered those, we're in chapter 2. Now we're very much seeing a very clear-cut application of these in chapter 4. So revenue, and revenue is an action, right? It's from delivering goods and services. So we deliver goods and services, and what's going to happen? Well, that's either going to cause assets to go up or liabilities to go down. So it's inflows of assets, or the settlements of liabilities. So assets go up, liabilities go down, and it's from delivering goods and services for the most part. The next one's an expense. Well, expenses, again, are from using goods and services. So again, we're using something here. If we use something, we may be using an asset, it'll go down, or we owe money for whatever the service is. So again, it's using up of assets or incurring liabilities from, delivering goods and services. So again, expenses, we have an expenses because we use something or consumed a cost. We consumed a cost, that's an asset. And then gains and losses. Gains and losses are peripheral. They're not core activity. They're peripheral type of activity. And those are going to cause our net assets to go up, if it's a gain. Or it'll cause our net assets, I'll just put in an A here, net assets to go down. Remember, net assets are our assets minus liabilities. So we're netting the assets, taking the liabilities out of the assets to see what the net is. You may have also recognized that's the formula for stockholders' equity, right? Assets less liabilities also gives us stockholders' equity. So stockholders' equity is the same amount as net assets, but really I'm thinking about things differently. Stockholders' equity, then I'm thinking of the owner's equity in the assets. Net assets is another way of thinking about that same number. Okay, and then lastly, page 164, we look into the components of the income statement. Here's very well, it's broken down. We have the operating section. This is our core operations. So you want to think of, this is the most important part of the income statement. It's our core operating activity. And then we have these non-operating things, like other revenues, gains, other expenses and losses. So if we have investment revenue, that's not our core revenue. Our core revenue, assuming we're a retailer, if we're a retailer, our core revenue is from selling things, not from investments. So interest revenue, dividend revenue, those would be secondary. Other expenses can be things like interest expense, and again, gains and losses fit in here as well. Our income tax cost goes down, is separated out. And then we have on 4, 5, and 6, we have just these additional items. And really these are the non-recurring sort of thing. So here we have discontinued operations. So if we sell, discontinued operations, so if we've got a segment that we get rid of, the gains and losses from abandoning or selling that off. Extraordinary items, You're going to need to know the definition of an extraordinary item. Those are gains and losses. In order to be an extraordinary item instead of an ordinary items go in category 2. So ordinary gains, ordinary losses would be from selling our property, plant, and equipment. But if it had been a gain or loss for something that's both unusual in nature and infrequent in occurrence, then it would be extraordinary. So if we have an earthquake in Missouri, that doesn't happen very often, that's unusual in nature, and it doesn't happen very often. So if an earthquake destroyed our facility or part of our facility, that earthquake, it would be an extraordinary item. However, in California, though, we would want to think about whether that's really an infrequent event. And earthquakes in California, certain areas of California anyhow, would not be considered extraordinary. Okay, and then this one, non-controlling interest, we really won't see that in this particular course, number 6. Really don't need to deal with that. That'll be in your advanced accounting course. And then also earnings per share. Earnings per share, we didn't really get into that in your lower level accounting courses in terms of it being reported on the face of the income statement, but it does get reported on the face of the income statement. We just didn't hit it that hard in that particular course. Okay, well, let's move on to problem 1 then. So there's our introduction. I went ahead, here's really the answer to problem 1. Problem 1 is just giving you accounts and dollar amounts. You can sort that out on your own without my doing that. Here really, in essence, is our solution for it. But I really want to use it, this problem, we're going to kind of go in more in depth and do some things with it and talk about it. There we go, a little bit better, easier to see. Well, the one thing we want to look at in problem 1 is really an understanding of that, we're going to see, a lot of components of the income statement. Really, we're going to see all possible things here just about. And what I want you to understand is that, for many analysts, they view, that parts of the income statement are more important than the whole. So we're going to see some components of this are more valuable and more useful for decision making than other components. Okay, and we can review this again. We see, here's our income from operations. That's our operating activity. So, that's our core. Sometimes that's considered the primary activity. So those are our primary operations. And then we go down to here from income from continuing operations. So we take our income from operations or other kind of stuff that goes in. Income before taxes, subtract income tax expense, and we get our income from continuing operations. This can be considered the secondary operations of the company. So we have our core going on here from our primary operations. Our secondary operations would be, another. So we have our core, and then we got our secondary, which actually should have probably been even smaller. And then we've got these irregular sort of stuff. So irregular items. And companies won't always have this stuff down at the bottom. It just depends if it happens. So if they've got rid of a segment or a component of their company, we'd have the discontinued operations. If they've got an extraordinary gain or loss, again, remember, unusual and infrequent. Okay, so, I've just listed out here. So we've got income from operations. That's a key number that an analyst would be very interested in because that's our primary, our core operating activity here. Okay, and then income from continuing operations, and then we get into this unusual sort of thing. In your narrative of problem 1, it only gave the after-tax impact of discontinued operations. Notice there's 2 components of discontinued operations. First off, we've got the operation itself. Let's say we didn't sell this until August. So we would have been operating this segment until August. This segment had a net loss, in this case, of $90,000 from January through August. So we're going to show the loss on operations of the discontinued component, and then when we sell it or get rid of it, the loss on the sale or abandonment of it. And then we're going to show that net of tax. because that's not going to be included. That income tax impact is not included in this income tax expense up here. This income tax expense is 1,244,000 is actually based on this 3,660,000. Actually, if you take 1,244,000 and then divide by that 3,660,000, you should get something like 34%. So it looks like this company's normal tax rate is 34%. So they had to pay 34% on this 3,660,000, and that was their income tax expense based on it. Okay. We're going to come back and figure out these numbers here. Even though the problem didn't give it to us, we're going to figure out the gross losses on these things and then what was the net tax impact on those. So, and then also they had a flood damage, some loss from flood damage. That was unusual for this location and a frequent occurrence. So that's an extraordinary item. Okay, so then we go all the way down to net income. Also, on the face of the income statement, we're going to have earnings per share. Earnings per share takes net income. By the way, it's earnings per share for the common shareholder. So if there's a preferred stock shares, or there are preferred stock shares, we're going to subtract out the preferred stock dividends. Okay. So the earnings for the common shareholder is net income, subtract out the dividends that went to the preferred shareholders, and of course divide by the number of common shares outstanding. And we divide by the number of common shares. Okay, so to get this $4.67, and again, there's components. We're going to start with, up here, income from continuing operations, and then we do these irregular items, these unusual things, discontinued, extraordinary, and then net income. So again, we take our income from continuing, we do discontinued operations, extraordinary item, and then earnings per share. Those four income items get converted to earnings per share. So we're going to take this 2,416,000. In the narrative, it tells you there was $80,000 of a dividend, and again, I'm leaving out the 3 zeros. So 2,416,000 minus 80,000, and then if you take that number, divide by 500,000, you get this $4.67. Likewise, well, not likewise, actually for discontinued operations, I'm really taking this $90,000, divide by the number of shares outstanding is 500,000, and you get 18 cents. For the second one, I just take this 440,000 divided by 500,000 shares, and I get 88 cents. Net those together, and you get $1.06. And then I do the same thing for the extraordinary loss. Take it, divided by the 500,000, and get 78 cents. And then for net income, I'm back in figuring out and factoring in my preferred stock dividend. So I'm taking my $1,496,000 minus my $80,000 dividend and get $500,000. Okay, so there's my earnings per share. All right, let's go on and look at retained earnings. So if we were doing a retained earnings statement, I'm going to give you a full-blown one. What you're going to see in Chapter 4, we start with beginning. Sometimes there will be things that we adjust to beginning retained earnings. We don't have any of those in this problem, but if we changed our accounting principle, let's say we changed from FIFO to LIFO 1 year, we have to go back and restate beginning retained earnings as if we had always used LIFO all the time. Or if we have a prior period adjustment, and again, that's due to an error in prior years, so that's pretty common in accounting to make errors. So if I made a mistake in last year's net income, I've got to correct this, net income gets close to retained earnings, so I've got to adjust this year's beginning retained earnings, or last year's ending, and correct it. Okay, so that's prior period adjustment and changes in accounting principles. Okay, then we're going to, let's go back and try to remember. Let's see, net income is 1,496,000. So we can put that in there, 1,496,000. Dividends, preferred stock, remember, had 80,000 in the narrative. And I'll just tell you, the common shareholders were given a dividend of 250,000 for the common. So that totals 330,000. Okay, so then we just take beginning plus net income minus our dividend, and we'll get ending retained earnings to be 2,146,000. Okay. Now, I want to do a what if, because I want to go back and figure out, well, what were these numbers in this problem? Because you're going to have to do this in some of your homework in Wiley Plus. So I want to make sure in this recording that you know how to do that. Okay, loss from discontinued operations, by the way, was $90,000, if you recall. Take you back just to refresh your memory. So it was $90,000 after tax. That means the loss was $90,000 less the tax benefit, the income tax benefit. Okay, and recall we said, well, it looked like they roughly had an income tax rate of 34%. So that means that 90,000 equals the loss. The income tax benefit is 34% of the loss, right? Because to get the income tax effect, we take the loss times 34%. Okay, so then 90,000 equals, well, 100% of the loss minus 34% of the loss is 66% of the loss. And then if I divide each of those sides by 66%, right, that'll cancel out. So 90,000 divided by 66% equals my loss now. And that should end up to be 136,364 ends up being our loss. So some basic algebra there. Okay, and so that's the loss. So 136,364, and let's figure out the tax benefit. So we're gonna, we get to deduct this loss, so we get a little benefit from the loss, and that's going to be 46,364. Oh, I didn't write that right. 364. So our benefit is 46,364 is our tax benefit, or if you prefer, it's tax savings. It's tax benefit or tax savings, whatever you prefer. I'm not going to go ahead and, just because of time, you can do the same thing with another number for the discontinued operation extraordinary item. Just set them up in this formula, right? They're going to equal the loss minus the income tax benefit, and you can work through it and get the same thing. What I want to do right now then is, in blue, I'm going to go put these numbers on my income statement. So let's go back and let's enter those in. So this was actually 136,364, and then we had a tax, net of tax benefit, 46,364. And so if I take the 136 minus the 46, we get the 90,000. Now, if we had taken the time, which we don't want to do because I don't want to bore you, but if we had figured it out for this, you should get 666,667, so $666,667, and then 34% of that, so take that times 34%, and you'll get 226,667. And net those together and you'll get 440. And then the last one, if you did the math, you should get 590,909. 590,909. Take that times 34%, and you'll get 200,909. And then net those together, and you'll get the 390. Okay. All right. One last thing before we stop. We have a lot of different tax numbers now on the income statement. We have the income tax expense on continuing operations. But we also have these tax benefits, and by the way, if there had been a gain, these would be tax expenses. So it's because we've had losses over here that we have tax benefits or tax savings. But if this had been a gain from the flood damage, I'm not sure how that could happen, but if we did have a gain from it, then this would be, not a benefit, but an expense. Okay, the next topic I want to talk about is tax allocation. Because we've really taken our tax cost and allocated it among these four things. Tax allocation. So we've split out, we actually have 4 tax numbers. So let's go over and look at, well, here's really our income tax expense account. Well, what's really in here? Well, what's really, and again, remember it's expense, so it goes up with a debit. So we actually have our income tax expense on continuing operations. But we also had numbers for those tax benefits that reduce the expense, the $46,364, the $226,667, and this $200,909. So again, these are all the details of that income tax allocation. So those are the very details. But if I draw my line for the income tax expense, I take the debit minus all the credits, I'll get a net expense of $770,060. That's our real net expense. But we didn't show it as one dollar amount on the income statement. We didn't show the net expense of $770,000 as one item on the income statement. It ended up being 4 different items. Okay? Alright, so that's a big overview of the income statement, statement of retained earnings, and this idea of income tax allocation.